Hello everyone, Clifford Bennett, Chief Economist, ACY Securities. I hope you're having a good day. Sorry about the avatar behind me. Can't get rid of him. He's just hanging around. Look, equity markets today, they fell in the US, they're falling in Australia. Why? Because there is a recession rushing straight at us. Now, a lot of people have referred to the decline on Wall Street yesterday as a Powell-induced rout. No, more precisely, more accurately what it is, the US economy is going into recession and the growing realization that the Federal Reserve is not going to save the day. In fact, the Federal Reserve will be encouraged to allow the economy to slow because in the Federal Reserve's mind, it only has one enemy, that of inflation. So it's going to allow the US economy to continue to slow down and even fall off the edge of a bit of a cliff. I really do think that that's the possibility moving forward. I'm not very good on the lighting here today. I'm just trying to duck the phone shadow as well. Maybe over here. Anyway, it's all good entertainment. It's really important to understand that the Federal Reserve is going to be continuing to raise interest rates. We've been saying it all along. We've been saying it for 2 years that they should have already been hiking, and then we were saying what they're going to do is have to chase rates aggressively higher at a later date. That's exactly what's happening. I've been pointing out for, 18 months, 2 years, the US economy is dysfunctional and in a lot of trouble, and forget the post-COVID boom experience, which was an artificial economic period engineered by, near zero rates, which shouldn't have been down there that long. And the same story, it's exactly the same parallel story in Australia, by the way. Rates too low for too long have created the crisis that we're now in, which is high inflation and an economy with nowhere to go, because it's quite a good effect, actually. So, I hope the producer leaves that in. Everyone deserves a laugh every now and again. So, economies are slowing, not just because of higher interest rates, but because of how, and I've spoken about this at length, I know, but for some people who are new, of how those stimuluses and low interest rates sucked out of the future economic activity to create that artificial boom coming out of COVID. And we're now in the valley. We're now in the economic valley. So it wouldn't matter what was going on with interest rates. We'd still be having an economic slowdown. And I think this is the point many people are missing. We would still be having an economic slowdown. So when you combine what would have already been a serious economic below growth, below trend period with central banks that are still raising interest rates, then you have a diabolical outlook for the economies being referred to here. More specifically, the Australian economy. Because the Fed's had a pause, the RBA has had a pause too, the Reverse Bank of Australia, as I like to call them. But the Reverse Bank of Australia has performed so badly, there was an independent review, an inquiry, and that found that there was a lot wanting at the RBA and made several recommendations. So one of the things hampering the Australian economy at the moment is that the Treasurer, whilst appearing immediately to be responding well to the inquiry's findings, seems to have slowed down somewhat and found other things to do. I don't think there's anything more important to do for the Australian economy and for Australian families than to have a responsible monetary policy setting. And that we do not have at the moment, because as I've said before, the RBA doesn't understand the new style of inflation, and it's applying 1960s, 70s, 80s textbook approaches, and those textbooks are no longer relevant, which means the RBA's monetary policy is irrelevant and doing more harm than good. The outlook for equity markets, though, and I have warned that I thought we were at a tipping point, a rollover point for equities for a few days now, for the past week or so, and that's definitely what we're seeing in the US and in Australia. Please be aware, this is not a momentary response to Chairman Powell just simply repeating what he's been saying all along for the last 18 months or so, or at least the last year. It's a response to the fact that the US economy, Main Street reality, is in dire straits, and the hope that the Fed would drastically pivot and cut rates to save the day is now quickly evaporating, making a whole lot of fund managers question why, in fact, they are so massively long equity markets, even if they are at average PE ratios, price earnings ratios. They should actually be at the bottom of the historic PE range, because the economic outlook rarely, maybe twice in the last 50 years, maybe 3 times in the last 50 years, has looked this ugly. This means equity markets are way overpriced, valuations are far too high, and if this notion of a US economy in trouble that will not be rescued either by political policy moves, because President Biden keeps saying the US economy is strong, so you're not going to get a rapid policy response. And we know that the Federal Reserve is not going to give a monetary response to rescue the US economy at this stage. So really, the US economy can move into a period of free fall. And where does that leave earnings and valuations? Much, much lower. This is a very serious fundamental matrix confronting the US economy at the moment. Australia's most definitely headed for recession for those 2 reasons. Really, a Reserve Bank that's not really sure what it's doing, plus a Treasurer who is slow to implement the policies of the independent inquiry he so admirably commissioned in the first place. Not a good outlook, and as I said in my article today, not a happy outlook at all for stocks. Take advantage of the modern financial instruments we have, make the most of the opportunity of the market being wrong on this occasion in the way that it is. Thanks very much. Clifford Bennett, Chief Economist, ACY Securities.